The economic world as we know it and the rules that govern it is over. We are witnessing a new era defined by sustained inflation, a series of sovereign and commercial and corporate debt crises, and a historic multi-trillion-dollar migration of wealth. Few are prepared. Those are the first words on the inside cover of Larry McDonald's new book titled How to Listen When Markets Speak, and he's our guest on this episode of The Resilient Advisor.
This is The Resilient Advisor Show with Jay Coulter.
Thanks for tuning into this episode of The Resilient Advisor. My name is Jay Coulter. Joining me today is Larry McDonald. Larry is the publisher of the Bear Trap Report and the author of A Colossal Failure of Common Sense, a book about Lehman Brothers, and his new book, How to Listen When Markets Speak, which we're going to spend our time talking about today. Larry, thanks for coming on the show.
Hey, Jay, it's great to be with you, my friend. Thank you.
All right. As a Lehman alum myself, I really enjoyed, if that's the right word, your book about the collapse of our former firm. You know, I get to work with a lot of younger advisors, and most of them have no idea about what we went through back then. They can't even comprehend it. What is one lesson that you take from those days that should be eternal to all folks in our industry?
Well, thank you, Jay, for bringing that up, because I tell my wife once a month as a former Lehman trader, if we sell 1 million books, we'll break even on our Lehman stock, our stock. And, it was a wonderful place to work. There were a lot of incredible traders. And I think the ultimate takeaway to today is that the fiscal and monetary response to Lehman was about $4 trillion. The fiscal and monetary response to COVID, the regional banking crisis of 2023, and then juicing fiscal into the election has been about 16 trillion. So 4 versus 16. Our first book was a New York Times bestseller. It's been ranked by the CFA Institute in the top 20 all time. But this new book really lays the foundation for portfolio construction for the next decade.
So let's dig into the book. So in there, you mentioned that you had the opportunity to spend some time with James Baker, President Reagan's closest advisor. You mentioned that he told you, and I'm going to read this, quote, Larry, you don't ever want to live in a multipolar world. In a multipolar world, it is next to impossible to stabilize global markets, specifically inflation. It's an awful place to be, and I hope you never have to experience. Larry, he didn't mince any words. Would you explain to listeners and viewers what he was talking about and how it sets some of the framework up for your book?
Sure. When you have a New York Times bestseller, our book was published in 12 languages, and we started doing these speeches. And I was in the National Bank of Abu Dhabi, and I met Neil Ferguson, incredible guy. I met James Baker, and the point that he was making, and Ferguson's made this point too, is that in a multipolar world, these superpowers have less control of the planet. And if you think of like 1968 to 81, coming out of the Vietnam War, global supply chains were not as smooth. There's a lot more inflationary pressures we have coming out of the Great Society with the Johnson administration. It's a lot like today, right? There's the fiscal overdosing then, fiscal overdosing now. Just look at we have the situation in the Middle East. The ATM, the cash machine for Hezbollah and Hamas has been Iranian oil, the cash flow. And so it's very clear that if there wasn't an election, that Netanyahu and Israel would have hit the oil assets. And I think that once the elections pass, they will hit the oil assets. But the bottom line is, in that kind of world where you've got two wars, you've got global supply chains that aren't working as well, you've got a lot of things like labor costs globally with strikes, and a lot of things are just different now. In a multipolar world, that element of inflation that's driven by global conflicts is really kind of could tip the balance toward a real sustainable inflation trajectory, the one like we had from 1968 to 81. It came in 3 phases. And I think we're in the exact same spot now. We just came through the first phase, And it was just very similar. 68 to 81, we had a big inflation spike from 1968 to 70. The Fed was able to get inflation back down from like 6.4 to down to 2.4. And then lo and behold, because of that multipolar world you mentioned, then we were off to the races with inflation again in that second round from 72 to 76. And I think we're just coming into that right now.
So to be clear, moving into a multipolar world that could turn out to be more inflationary than people might be thinking. Am I understanding your thesis?
Yeah, the multipolar world, I think it's pretty, I can confidently say we're already in it. I mean, we've had a lot of global conflicts, whether it be, Ukraine. I mean, think about the United States spending $120 billion. I mean, that's an incredible amount of money. And that money's going to ooze around the planet, right? And then everything that comes with supply chain problems and everything that comes with, the Suez Canal, right? They're attacking our ships. We can't get all supplies through there. We can't get commodities through there. All that's really juices sustain inflation. So I think we're in it, but a really powerful multipolar world, like on a scale of 1 to 10, to take it up to a 10 in terms of bad, that would be as if, when Israel really strikes those oil assets, because then oil would go to $80 to $90 a barrel, and then all of a sudden, Fed policy in Washington is completely, they would lose control, right? They would have completely loss of control over inflation and interest. They would have to basically force a nasty recession to calm down, inflation.
Larry, preparing for this interview was a lot of fun. You can see I dog tagged this book all the way through. I had to hone it down into questions for this interview, and this is one of my favorites. In your book, you say that the dodos of the future will be those who cling to their ailing growth stocks. Boy, you talk about a way to trigger some talking heads in the media today. You also go on to note that oil, gas, and industrials and materials accounted for 49% of the S&P 500 in 1981. And by 2021, it had dropped to 12%. And then you make the case for why this dynamic is going to revert back. How do we need to be thinking about inflation, deflation, and asset allocation?
Well, thank you, Jay, for all that thoughtful research, because I do these all the time, and it's just a pleasure when someone digs in, and it makes the conversation so much better, I think. And it's just one thing that we talked about in the first book is election years are very powerful. And if you think of, like, I've done hundreds and hundreds of interviews on CNBC and the media, so I've gotten to know a lot of the media players at Fox and Bloomberg and CNBC. And I can tell you for a fact that in election years, the economic data is a lot of times skewed. Like, think of the Bush administration, 2008. The whole thing was sugar-coated. That's why the financial crisis was such a surprise, right, to so many people. Everybody get blindsided because it was an election year. Bush wasn't running, but McCain was, and the Republican Party wanted to keep control of the White House. And they really sugar-coated a lot of economic data. And then lo and behold, we had the data turn in after the election. And I think it's very similar to now, where data is been kind of sugar-coated with all that juicy fiscal policy. We've got a deficit that's almost 6.5% of GDP. That's like a World War I, World War II type level. And so we're deficit spending, creating a lot of government jobs. That's basically pumping up the jobs data. But now when you come in past the election and go into the new administration potentially, that's when they do a lot of kind of house cleaning. If Trump were to win, it sets up a real dynamic where they blame the former administration. Same thing with Kamala. If Kamala Harris wins, then she's in office for 4 years, so she can really blame them. She can throw a lot of dirt on the Biden team, right, and say that she was out of control. She's the vice president, and so you're going to see a lot of that, and that's why that sets up for, I think, a real sustainable inflation bounce next year, which I can get deeper into.
Yeah, we definitely want to get into that. Inflation is one of the bigger concerns in my audience, and not just how inflation is impacting their client portfolios, but their clients as well. And I think you have some great talking points around that. But first, in the book, you talk about Josh Brown's concept of the endless bid. and then how later it could become the endless offer. This is in a chapter called The Dark Side of Passive Investing, where you make the case for why investors need to be skeptical of passive investing. It's quite compelling. Would you walk the audience through how you think about passive investing today?
Okay, it all comes down to the risk-free rate. And Josh was a brilliant strategist, thought leader. One of Josh's points was that, interest rates were so low and the boomers were young enough and had a lot of money. When he made that statement, it was like 10 years ago, I think. So the boomers had a lot of money and interest rates were at zero. And the boomers the oldest boomer today is about 79. So the oldest boomer then was about 69. So two things were going for passive investing. The boomers, which represent about 79 trillion of wealth, 79 trillion. So they were young enough and there were zero interest rates. Essentially, the Fed was suppressing the cost of capital and juicing the market. Today, the 30-year Treasury is like upwards of 2.3, 2.4%. And in the last year and a half, we've had rates higher. The 10-year has been kind of not breaking out to the old highs, but breaking out from the local highs. And so when you have the risk-free rate in 5 years and 10 years and 2-year treasuries that high, and at the same time, the oldest boomers are now 79. So if you just talk to any financial advisor, you take the client's age, and that's the percentage of his assets or his or her assets that should be in bonds, the basic rule of thumb. So an 80-year-old investor should have 70 to 80% of their money in some type of fixed income or cash, and a younger person can have more money in the market. So for those two reasons, we're coming into a period where the $79 trillion that's in the hands of the boomers, eventually that money is going to make its way to the millennials, but there's going to be this transition period where the boomers have to get a little bit more cautious, and equities have gone up a lot. And so the probability that with rates up here, it's almost like a 1987 crash situation where I'll never forget going through that with my dad. I was in his brokerage firm and rates popped in the summer of 87. And at some point, and it won't take that much now because there's, for a lot of reasons, there's a lot of leverage out there. But if rates pop another 20, 30 basis points up, you're going to see a lot of wealth move from stocks over to bonds, and people, and that would create potential crash situation over the next 6-9 months.
Let's go a little deeper on that. For the advisors that are building portfolios today, when you talk about rates going up, are you referring to the short term or the long end of the curve? Short-term rates or the long end of the curve?
It's the long end. You're right. If the Fed's already cut 50, and I think they cut 50 because interest on the debt now is 1.1 trillion, and we argued over in the Bear Traps report that they had to cut 100 just to get interest on the debt. That front end is where they're financing it. Mm-hmm. And if they don't get the front end down, then the average weighted coupon on the portfolio today, think about this, the average weighted coupon on the U.S. government debt portfolio is 2.6%. And the T-bills on the front end of the curve are 4.5%. And so if they don't get, and the long end is 4.5%, so the curve's very flat. And so if they don't get the front end down, then interest on the debt's going to go to like 1.5 trillion from 1.5 trillion very quickly. And then the Fed at some point would have to come in and support the bond market with buying bonds. That would get you a much weaker dollar. That gets you the real colossal migration, historical migration. It's just, I can see it as clear as day. It's coming at us. That would put right now there's 23 trillion in the NASDAQ 100. All this passive money, all this, like at least 5 or 6 or 7 trillion bucks is going to go from financial assets, which are stocks, growth stocks and bonds, over to a good portion is going to go to hard assets, and that's your companies that actually own things in the ground. They own assets. They own, whether it be platinum, palladium, gold, silver, whether it be natural gas, oil. These are the types of investments that are going to be a much larger percentage of the S&P 500 over the next 5 years.
Larry, in your book, you have a whole chapter dedicated to commodities and hard asset investing. I feel that there really hasn't been a whole lot of great press around these asset classes over the past maybe 2 generations. How should financial advisors and investors look at investing in commodities and hard assets going forward?
Well, the first thing you do is just look at the top, like 1981, were the top stocks in the S&P. And, you had some gold miners in the top 20. You had some oil names. Exxon was forever. Exxon was the top market cap company in the S&P. And so you think that one of the things that we talk about in the book is we took 5 million jobs out of the United States and we moved them around the world to emerging markets. And so if you're in India and you're working on a call center, you're making about 50 times more than your great-great-grandparents. And so countries like India are growing at a very, very fast pace relative to the rest of the world. And so the Davos crowd meant well. We've decimated the United States. I mean, there's fathers going, there's fathers in the Midwest that are literally addicted to opioids because they're so tragically depressed and decimated by all these jobs leaving the United States. And life expectancy in states like Pennsylvania and New York is coming way down because people are not living longer because of all that stress of losing their livelihoods and having to go from working in a very high-paying job to a very low-paying job. And so we've taken these jobs, we've moved them around the world, so we've increased the standard of living globally. So we're creating a lot of carbon consumers, but we haven't really invested in the infrastructure to support all this new demand. So capital expenditures, if you look at capital expenditures in oil and gas and metals in the 2010 to 2014 period, 2010 to 2014, that was on a trajectory that if we kept that to today, we're essentially in a $3 trillion hole. And what's going to happen is around 25, 26, the demand from energy from around the world relative to the supply of what we've suppressed the supply. That's going to create a pretty nasty energy crisis. And that's what the bottom line is. My point is, over the next 5-10 years, you're going to see a BHP or an Exxon or a Chevron in those top 10, 15 names in the S&P because energy and materials are probably going to go from, say, 7% of the S&P to maybe close to 20%. And so we're not going back to 1980 where industrials, materials, and energy were 49%, but I think we're going back to 30 from 12, and that's where you get to reconstruct your portfolio. Forget about the 2010. Everybody's in the 2010 to 2020 portfolio. Everybody's long the same thing, and it worked for a long time because we had a very, very certain deflationary world, and now we're moving into, even though we're in denial because I talked about that election year, they really want us to believe that lower inflation is sustainable. So there's like that election year brainwashing of the public. Everything's fine. Inflation's coming back to 1-2%. And that's what has everybody so deeply, deeply embedded into this 2010 to 2020 portfolio. But once people start to realize that inflation is now at a much higher long-term trajectory, that's where you get much more higher bond prices, higher inflation. That gets you that move from financial assets to hard assets.
All right. Well, I want to talk about the portfolio allocation percentages that you recommend in the book. But before we do, if you're an investment advisor today and you have discretion over your client's assets and you feel that you need a 5, 10, 15% allocation to real assets and commodities, where do you think advisors should look to gain that exposure today?
Yeah. Well, there's two things. There's the commodities and the commodity equities. So at the early stage of a bull market, think of oil stocks in 2020, 21. the first stage is people go into the commodity. And so there are ETFs like the SLV for silver, the PALL for palladium, the PLTM for platinum. And so if you're in gold today, which has done incredibly well, you want to be diversifying away from gold and into the other metals, because gold is a $16.5 trillion market, and the other metals in the commodity side, all these ETFs, platinum and palladium are around $300 billion. So think of like $16.5 trillion versus platinum, maybe $400 billion. And so all the gold ever mined could fit into the Olympic swimming pool, but all the platinum and palladium ever mined would go to your ankles in that same pool. So you want to start thinking about having an allocation toward the commodities themselves, and then the commodity equities. And so I would say between those two, I think you could be up to 50% of the portfolio construction in commodities and commodity equities. That would be aggressive, but I think that, if you look back to 1968 to 81, that type of portfolio destroyed the S&P. I think the S&P was flat for a good decade there.
Larry, some investors have some concerns over precious metals ETFs and whether they would be able to withstand the crisis that they're in the portfolio to help protect against. Do you have any concerns about the ETF structure for precious metal investing?
Yes, but I also have some concerns about the top, the top 3 stocks in the S&P. At one point in the last month, they got up to 24% of the S&P in the top 3 stocks. I think it was 24. If you look back the last 15 years, that number used to be, the top 3 stocks used to be 8%, 9% max. And so there's a lot of danger in the S&P, especially if you go to that endless offer. You could have a situation where passive, and this sounds crazy, but if there's so much wealth in there, and if there's something that happens in the market, you could literally have the market have to shut down for certain periods of time to allow people to get out of these crowded trades. In terms of the commodities themselves, like the SLV or the GLD, yes, there are technical issues around the gold and silver that these funds hold, and how much gold they actually hold relative to demand. Yes, those things you want to talk. That's why you need your advisor, to point you in the right direction and keep you out of trouble. And we saw this with the USO in 2020. The USO is an oil ETF. They had this thing structured where a lot of these commodity ETFs they're rolling the futures, right? And if they roll the futures, it's very expensive because they're basically the fund manager has to, every month, buy the front end, and they had the whole fund in the front end of the curve, and it was a disaster. And then they had to actually they changed the prospectus, and they had to basically instead of owning just the front 2 months, they own the front 5, and that saved the fund. The fund was could have gone down because of the kind of miscalculation in portfolio in that kind of portfolio construction.
Yep, that's right. As my friend Dan Weisskopf likes to say, structure matters.
Yes.
Larry, in your book, How to Listen to When Markets Speak, you lay out a hypothetical allocation for the 2020s. I want to read it off for viewers and listeners, and then tell us your thinking around these allocation percentages. So you're recommending a 10% allocation to cash, 40% allocation to stocks, 30% to bonds, and 20% commodities. How did you land here? What was the thought process?
Well, the 60-40 portfolio, and I'm really proud of the book. Robert Ben Battenberg worked on it with us. He's our CFA, our strategist. And then, like I said before, I talked to David Tepper in the book. Legendary investors are in this book. I sat down with Charlie Munger, David Einhorn. And, one of the things that David said to me back in 2021, he was really questioning risk parity. Because that's talk about another crowded trade. Everybody was long this 60% stocks, 40% bonds portfolio, the 60-40. And there was just look at the RPAR ETF, R and then PAR. And the 60-40 portfolio, 60% stocks and 40% bonds, that has dramatically underperformed. Einhorn was like spot on. And that's because we had that nasty inflation period in 2022. So it killed the performance of risk parity. And so we made this prediction in the book. We wrote the book 2 years ago. It came true, but I got those ideas from some really incredible fund managers. And now if inflation bounces, it's going to do another dance. It's going to continue to hurt risk parity. Just look today. There's an Apple bond out there that it's the 2.55% due in 2060. It's a long duration bond. But it's trading at 61 cents on the dollar, Jay.
Wow.
I mean, think about this. This bond was issued at like 102 or traded at 102 in 2021. It traded at 102. It's at 61, Jay. I mean, think about it. It's a $1.5 billion bond. I think it's 1.7. So it's a $1.7 billion face, and those bonds are only worth $1 billion now. So it's a $700 million loss on just that one bond, Jay. That one bond. And multiply that times all the bonds. So when interest rates go up, bond prices go down, and if there's sustained inflation, then all of this portfolio is stressed. So this is why we wanted to say you want to have a good chunk, and now I would even frame it up to even more commodities. And in terms of the bond quotient right now going to the new year, which I really want to get into, there's a real ticking bomb for the first quarter of next year after the election in terms of the bond market. But recommend like a lot of cash, a lot of commodities, maybe like 50% cash and commodities and 50% stocks. And not a lot of bonds right now.
Yeah, wow. Well, let's dig into it. What are you concerned about going into the first quarter of next year?
And what I mean by bonds, Jay, you can own 2-year bonds, right? 2-year treasuries, that's fine. But so picture in your mind, you're Janet Yellen, you have an election to win in 2024, but your government's spending all this money. I mean, $2 trillion a year. What do? If you need to borrow $2 trillion, Jay, if she had issued $2 trillion of 5 and 10-year bonds, those bonds would have moved like this in the market violently because interest rates up, bond prices down. That's the way bonds work. Interest rates up, bond prices down. But what she did was a very conniving, dangerous move. She didn't want to have all that bond volatility in the election year. So what did she do? She has stacked the deck on T-bills. And T-bills, Jay, T-bills don't move. So imagine if you're issuing $2 trillion of T-bills and interest rates go up. Because they mature in less than 1 year, they don't move. So you have two choices. You're Janet Yellen. You can issue $2 trillion of longer dated bonds, 5 or 10-year bonds. Those bonds are going to move violently in an election year, and it's $2 trillion. And we showed you what happened to the Apple bond, right? That's just one example. But if Apple issued a T-bill, which is, so let's just call it Apple again, a T-bill or the United States government that matures in less than 6 months, it's not going to move, Jay, right? So what she did was she sucked the bond volatility out of the market in election year to help the administration. And don't get me wrong, I'm not making a partisan move here. This is something, like I said, the Bush administration pulled every trick in the hat, right? So to try to help McCain. So this is something that goes back, 50, 100, like almost 100 years of games, right, that people play in elections. But now the next Treasury Secretary, Jay, you have in 2024, 25, and 26, 15 trillion, Jay, of bonds that have to be rolled over. And a lot of those bonds are in T-bills. So the next Treasury Secretary has to issue much longer dated bonds because Yellen has stacked the deck against the next administration. So one of the things when you talk to, we run a Bloomberg, you probably see the computer moving behind us. We run an institutional chat on Bloomberg with hedge funds, mutual funds, and pension funds. It's one of the largest platforms in the world with the professional investors. And the conversation that I'm hearing now from the billionaire fund managers They run a lot of family office money, a lot of institutional investors. They think that we're going to have a Liz Truss moment in the United States in like the first quarter of next year, when the new Treasury Secretary has to start issuing longer dated bonds. And we just don't have, remember, one of the things I talk about in the book, sanctions, confiscation of property in Russia. We just don't have, because of we've abused the sanctions on all the emerging market countries over the last decade. And Republicans and Democrats, it has nothing to do with politics. Republicans and Democrats have abused sanctions. And then the Ukraine war kind of forced the United States into draconian wealth confiscation, private property confiscation of Russian assets. So all of these emerging market countries are just not buying as many bonds. And there's a lot of interest to Jay. Listen to this. So let's just say there's $40 trillion of dollar-denominated debt. Those the bonds in the world now pay a lot. All these new bonds have issued in the last year. They pay these high coupons, much higher coupons, double, triple what they used to be, like 2020, 21. So these countries have all this cash, and you know what they're doing? They're buying gold, and they're hedging their way out of bonds, because everybody's table max long U.S. government bonds. And so because of all the sanctions and the kind of the abuse from the U.S. government over the last decade, emerging market countries, foreign governments, central banks they don't want to hold as many. So we're going to have this like less global demand for bonds over the next couple of years, an incredible new supply of bonds, and it's going to force the Fed to come in and be the buyer of last resort. And that's what gets you this real spectacular move into hard assets and commodities.
Gosh, there's so many potential follow-up questions there. Let's just start with one that I know my audience would care about, and that's the impact of that scenario on real estate prices. So if they're artificially bringing down short-term rates and longer-term rates, 10, 20-year paper starts going up, obviously that's going to drive up mortgage rates. What happens to housing here in the United States?
Well, yeah, so the first stage is, and it's happening now, look at the home builders, the way they're acting the last couple of weeks. They're buckling. And so if you look at the financing in the mortgage market right now, I think we're up to 7% on the more longer dated mortgages. And so that's going to crack the market. But then the Fed steps in, Jay, and then at some point, starts to hold down interest rates on the long end, or it depends on where they try to hold rates down. But they'll hold rates down in some part of the curve, and that will create a weaker dollar. Inflation is going to be great for real estate. But there's two stages to it. There's like the first stage, which we're coming into now, where you get higher inflation, you get higher bond yields, that cracks the market, you get to move down. Then you get the response from the Fed and move back up. That's like a 2-year trade. So, but overall, I mean, inflation is really great for real estate. You just, like, once again, you want to be along hard assets.
Yeah, it's great for real estate if you own it, not for some of the younger generation, most of the younger generation that haven't been able to leg into it yet, which will come with its own set of consequences, right?
That's what you see on the campaign trail. Kamala Harris, I mean, they're creating all these like wacky new programs to try to like support younger people that need to get into these homes, but they've created all these dislocations. But that's just going to, any kind of program like that from the government that feeds more capital into it's a potential homeowners or home buyers, that's just going to support prices. And so it's just a classic thing with governments, right? And the Fed and monetary and fiscal policy. When you play with a serpent in a cocktail, and the unintended consequences of what they've done since COVID, like I said, the fiscal and monetary response to COVID, to the banking crisis to 23, and then the election year juicing of the fiscal is $16 trillion. And they've created so many unintended consequences that they're going to have to come up with all these different plans to get around and these solutions. And it's going to be very interesting.
In your book, How to Listen When Markets Speak, you make the case for why America's position as the world's premier reserve currency will weaken. At a high level, what do we need to be thinking about?
What I talked about before is around all those central banks and the coupons. That's the big thing. So they're so long government bonds. There's literally, I think, $40 trillion of dollar denominated debt at least. And so that just those coupons alone are driving money into gold. But then there's the element of like, okay, China's very exposed to the U.S. bond market. They're buying a lot less bonds than they used to. Japan, aging population, they're buying more, but they're not going to be there to really make up for the rest of the world. So in terms of your bond sales, if you don't have enough global buyers of bonds, let me give you an example. The 2-year Treasury auction this week. We do the auctions all the time, right? We do auctions every week. But to give you an example, the average 2-year Treasury auction is like $70 billion, Jay. Now, if you go back to 2019, we were like, $20 billion auctions, 20 to 25, maybe 30. So this is just the 2-year. This is just one auction out of many. So we're trying to sell like $70 billion. And there was a 5-year auction, I think, today. And so it was a 2-year auction yesterday, 5-year auction today. So these auction sizes, Jay, are like way above, like think of Lehman Brothers, how bad that crisis was. And the auction sizes today are, I think, double Lehman levels, which was like trying to pay off this huge financial crisis. And so if the global investors are not there in size, that once again forces the Fed in to support the bond market, and that gets you that big trade. But in terms of the reserve currency status, over time, because we're trying to, but because we have to use inflation to monetize the debt. The only way you get out of a $35 trillion debt hole, Jay, the only way 36 trillion is to keep interest rates below the rate of inflation. So interest rates below the rate of inflation. That's called financial repression. And that's what monetizes the debt. That's how you get out of it. And when you do that, you weaken the currency over time. And so we're not going to lose the reserve currency status, but are we going to go, are we going to cut the U.S. market share way down over the next 5 years? Yeah, we're going to be, a much smaller player than we used to be.
Larry, in your new book, on page 50 specifically, there is a chart showing the impact of the Fed stimulus on the S&P 500. For listeners, there's a direct, undisputable correlation in this chart between the S&P 500 and the Fed's balance sheet going back to 2008. Larry, given everything that we just spoke about, and with both political parties fully committed to more and more debt, do valuations even matter anymore for equities?
Okay, so right now we're trading at 22 times forward earnings, which is one of the most extreme, one of the most extreme levels in terms of forward earnings. So that's in terms of what earnings are supposed to be next year, and so we're priced for perfection. And not only that, but the risk-free rate relative to equities points toward everything, every model, everything I can tell you. We're coming into another lost decade for stocks, because historically, whenever we're this stretched, where bonds are getting more and more competitive to stocks, you go through a period of time. We've had, in the last 60 years, I think we've had 2 or 3 10-year periods where equities were flat. Now, where equities have done well, like you said, is when the Fed's, doing quantitative easing, or this past year, in some ways, we're doing kind of stealth quantitative easing, because the Fed was, the Treasury was issuing so many T-bills, and there's a lot of games being played behind the scenes. So there's a lot of things they did to get, they just want to get us through the election. But next year, and as inflation bounces, it forces us into an entirely different playbook. So yeah, the probability that we go, say 5 to 10 years with equities flat from here is very, very high.
Yeah. Larry, final question. Viewers, listeners, I highly recommend you go pick up a copy of his new book, How to Listen When Markets Speak. If you're a financial advisor, it actually makes for a great conversation piece with any prospects or clients that are intellectually curious about the market. And inside of there, you have all of these inserts that you call Investors Take Note. One of them I thought that caught my eye that I thought my listeners would appreciate is your lens on the importance of the 52-week high and 52-week lows. What do investors and advisors need to know about that important metric?
Well, one of the things that David Tepper, when I sat down with David, he wants to measure a capitulation, and you want for and this is for this takes so much discipline because testosterone is the great enemy to investing. When I sat down with Charlie Munger, he said, the hardest thing to do, Larry, is stare at a screen all day and do nothing. But what Tepper was getting at is that if all you ever did the last 30, 40 years is buy stocks in size when new lows on the New York Stock Exchange are 1,500, 1,600, 1,700, and then sell them slowly over 10 years, that has been the best formula historically for any. I mean, literally, you would crush the S&P if you somehow had the ability to do that. I just noticed that right now that the rate of change in Warren Buffett's cash portfolio at Berkshire is really violent and very sharp. And Buffett has been known, if you look back at the history of Berkshire, they deplete their cash when there's a lot of new lows on the New York Stock Exchange. I don't know what number they look for. They're just looking for valuations. But the bottom line is investors should take note. The rate of change in Buffett's cash portfolio over the last year has been, I think, one of the smartest, most violent in terms of additional cash. So he's basically preparing for one of these moments that Tepper's talking about. And that's something I think that's why you want to have that heavy cash component, because you want to be there for those moments when the mad mob is heading for the exits.
Well, Larry, thanks for taking the time to come on the show. Viewers, listeners, pick up a copy of How to Listen When Markets Speak wherever you buy books, and check out his website, The Bear Traps Report, at beartrapsreport.com. Larry, thanks for coming on.
Thanks, Jay. It's great to be with you.